last week we had, the end of the September month, usually a really tough time for markets, but we did get some fantastic news from China. That is just continuing today. More and more stimulus just being thrown onto their market. That rally has been unreal. It's like 20% in about 4 days, Brian.
Yeah, I mean, when you look at even if you wanted to invest in the United States, I like to look at the ETF FXI, the Chinese ETF ADR. Tremendous move to the upside. It really had struggled over the last couple of years, and we kind of had been anti-China in investments with our international. At least my view on international holdings being somewhat underweight in that area, but certainly the Chinese market is sort of revived again. At least for now. It's shown at times where it's broken out to the upside, and that rally has been short-lived. So we'll see if that can continue.
Yeah, we'll see how long it lasts. Exactly right. We've seen these periods for China, like 2008 was a great example where it just had these tremendous short bursts of excitement, short bursts of bull markets, and then just kind of fizzled and went sideways for a long period of time. I'm not convinced that, I think the government is not as concerned about capital growth. It's not as concerned about the free capital markets as other parts of the world, which I like to invest in. It's just not for me long term. Maybe short term sets up nice for a trade. Long term doesn't seem right. One of their neighbors. Key competitors in the future having a recent pullback is India. I like that market a lot more long term.
Yeah, I mean, well, that stock market also has had a big boom over the last couple of years. So could it be a little bit overbought, maybe? But yeah, longer term, I think you're right, Joe. I rather go with someone that is a supporter of free capital markets and invest in there for growth in the future. And like you said, I agree. Short term trade, maybe. Long-term view, I do like India better.
Let's look at what we got going on for this week. It's going to be a big week when it comes to the data for sure. We got jobs report that is going to be crucial, and we also have the manufacturing PMI. I think those are going to be two big economic data points. I'm kind of leaning toward the Fed wants to be aggressive out of the gate. The Fed's going to be pushing towards another 50 basis point cut. We'll see if that materializes. But I'm more in the lean of along the line of thinking that good jobs data, good economic data is going to be good for the market because we're getting the cuts either way.
Well, yeah, and every week, really, the jobs report is something. I mean, we've mentioned this before, right? Like, I think October, November, December jobs report that the unemployment is not continuing to tick higher because that could lead us down a path of very sharp, steep volatility. I think although volatility, I believe, is going higher, the less steep path is the 1990 scenario where unemployment stayed low, GDP continued to grow. And although the Fed was cutting rates, it was helping to actually stimulate the economy. And we'd like to see that. So I think this jobs report is going to be very critical. I think this is why the VIX is trading as high as it is right now. And we'll get into our little volatility section here and talk more about that.
Yeah, for sure. But again, we got a question whether or not they're going to be really 0 to 50 basis points worth of cuts coming up at the next meeting. Is there going to be a jobs report? This is the last jobs report before the election, Brian, or is there one more Friday before that Tuesday? I think the election's the 5th. Does that make so the 3rd is Sunday? I think the 1st might be the Friday, so there might not be a jobs report.
There will be a jobs report November 1st on Friday before the election. Then we'll have the election.
No, if the Friday is the 1st of the month, it's not. It'll be the next week.
So there you go.
So it'll be no jobs. This is the last jobs report for the election. Can you believe it?
Yeah. So okay. So then
last chance to cook the books, I guess.
Yeah, all of a sudden the numbers will probably come in normalized, I guess November 8th. following the
Right.
election.
And
So
also the day after the election will be the Fed meeting too. So like we're going to get the election in November, and then his jobs report and a Fed meeting. There could be, we could find some things out that we didn't really we could have been pretty useful a few days earlier.
yeah. So I mean, this will be one data point we take away from it. But to your point, the volatility has been trading higher. You heard it. The first week in November is going to be action packed. The first full trading week in November is going to be action packed. So this will be a critical month to see where the market wants to move things, and then we'll get the news event and we'll see where things go.
Let's see. We got a question coming in. Thanks everyone for tuning in. Really appreciate it. Always make sure to put your questions out here. We'll highlight them here. A question coming in. How are you prepping for election results, especially as you're sharing that some reports will be post-election? Very, very good question. I would say we're definitely prepping as usual. With our volatility protection, we're carefully navigating that. We'll talk about that in just a second, how October is lining up already. Like it's really high, very steeply bid. That'll come after the October future expires, Brian. But I hear people saying, not to get too into the weeds, but I hear people saying they want to sell out of their stocks if so-and-so wins. If one side wins, I want to go to cash because there's going to be a disaster. And I, as an advisor, I can understand the thought process. I have some sympathy for that, but I can't advise people to do that. It's just the wrong way to look at it. People are saying, people said that in 2020, this is going to be a disaster. People said that in 2016. People said that in 2012. It seems like every election, people are just nervous if their side loses that everything's going to go to HE double hockey sticks. And what usually happens is the market goes higher. Yes, if you want to buy and hold only when one side is in office, then you're going to be way behind. The best result is just to buy and hold. And for me, if there actually is a pullback, if people do decide to sell off of the result, I'll be a buyer on that pullback.
Yeah, I think, when it comes to the political, navigating that scene is you can get stuck sort of on your like one pole of the earth of whether you're, liberal or conservative, and the other side then to you looks like a disaster. I mean, personally, I want to react to the actual economic data that's going on. I want to react to how volatility is trading. I want to react to trends and macro trends going on in the equity markets and trade off of that rather than political. Now, personally, it will have an effect on, if there's a certain tax policy that gets pushed through from one candidate to the other, that will have some sort of effect on you as an individual. But for me as a trader, for me as an investor, I'm looking at it more holistically, looking at how the macro environment is shaping out and then making decisions off of that.
Yeah, but in either case, though, I think volatility is still going to be there no matter what. So let's take a look at the volatility landscape right now as we sit. So here is something we look at every week. If you're new to watching us, make sure to tune in every Monday, 1 Eastern. This is the skew of the S&P 500. This is looking at the price of the 25 delta put 1 month out versus the 25 delta call 1 month out. You can see as things get more volatile, people pay a lot higher premiums for that put. And this kind of is a leading indicator for volatility for us. And lately, in the very recent history here, it's we're trending a little bit higher here, Brian.
Yeah, it seems like we're kind of trending back into normalized range of how that skew plays out. Where, I mean, look, there has to be a premium to pay a put because historically, well, it doesn't have to be, but historically, when the market moves down, it moves down faster than it moves when it's going up, and so people pay extra premium for put protection. People are more worried about their investments that they have in the world, and they pay that extra premium to own those downside puts. And so, yeah, I mean, look at this on the 5-year skew. You look further back. You can see that historically above a 4 to 1 ratio between the value of those puts versus calls, that's sort of normal. So we're getting back into it, but it's also an indicator that, there's this momentum shift that something is coming and people are getting worried about that, and that's why they're pushing puts up in value.
Yeah. Again, this is something kind of I've been talking about. I think this is a norm that I think we were in this level here. I think we're shifting out of that. I think we're going back up or above this level. I think that's what I'm expecting for the next few years anyways. It's just elevated volatility. We've just kind of snapped out of that spell. Here's the current VIX futures. I brought this up right off the get-go. Look at this October future, Brian. It is really elevated compared to where the cash is.
Yeah, it's unusual on normal circumstances, no doubt. Historically, if we've seen this where the next month future relative to the VIX is higher, and then the back months after that are lower, that is fairly unusual. I mean, just look at it like how that shape of that curve looked 2 months ago. But when we look at it and what we just talked about, I mean, look, that first week in November is going to be lots of news to digest for the market. People are expecting some volatility coming up to that. And the October future, frankly, is tied to November S&P 500 options. So I know that's a little confusing, but that's just how the math works. And so since that October future is going to settle into the value of the VIX, there is some expectations that the VIX is going to rise into those November options and where those are trading. And there's some anticipation that we're just going to see some market movement over the next month.
Do you think that after the October expiration, we might get a different shape of this curve? We might have the VIX trading higher, but because the November futures will expire in the middle of the month, well after the election, well after some of it's shaken out, it'll look kind of like this, where you have the cash higher than the future.
Yeah, I think that's a great point, Joe. And typically that shakeout is that type of curve looking is one in which traders believe there's going to be more market movement than there currently is in the marketplace. Mm-hmm. It's people trying to own S&P options to play a big move. And so I think that is how the shape is going to play out. And that might actually give some VIX futures traders some opportunity to own those VIX futures, frankly.
Interesting.
Yeah.
I
mean, full disclosure, like for our clients, we are currently long, what would be considered VXX or short-term VIX futures right now, based on the current market landscape. But certainly if that shape turned out like that too, I'd also want to be a buyer as well.
So yeah, that should be interesting. That's what we'll be watching. Again, normally like the curve looks something like that, right? So what we have now is just very unusual. So we're going to expect maybe in January it'll go back to the normal cave. But this is just an opportunity for people who will understand the dynamics, understand what's going on, are not just blindly going and trading it systematically, but more dynamically looking at the landscape. I think that's some opportunity for people who know what the history is and what they've seen going back. So
yeah, I think it's safe to say that we're also set up for clients to play for that move as well. So we're trying to look at this shape and trade with it.
So yeah, absolutely. Here is the S&P 500 2-year trends, Brian. This is something you gave me flack last week. You were saying, hey, this graph is done. We don't need these anymore. Well, look at how closely we're following this upper trend line here. This old support is turned into resistance right here. I'd really love to see it crack that and get back up there, but maybe this will just be an area where, hey, this just kind of is, resistance, and maybe we can just follow this trend line higher this way. Again, that'll still be really good news for bulls if we continue at least staying above this spot here. But again, I'd love to see it crack up above this spot here, but we haven't been able to do so yet.
Yeah, it really has been kind of sticky towards that bottom end of the green area channel support, now acting as resistance. So that will be one to watch, and maybe that's where we see the skew. We talked about the skew and volatility calls relative to puts. Maybe call buyers will come back in if we can ever get through it back into that upper green channel, and they'll sort of be this giddy up for the markets to the upside.
Yeah. Well, it kind of brings us to the main story basically for the day, which is kind of what I like to see, the broadening out of the semiconductor index, the broadening out of the AI trade. Everybody knows about NVIDIA, Brian. It's been a fantastic company with a fantastic run over the past couple of years, but there are a lot more companies in this index, in this chip world, and there are a lot more companies that are participating in this AI race. These data centers are vast, they're enormous, and it takes more than an AI chip to make the whole thing work. So here's the chart. We've been talking about this past few weeks. We love this rally. We need these semiconductors to really decisively get above here for this really to be game on for the bulls to get back going. I think that'll also coincide with the S&P 500 getting into that upper green channel too. But I'd love to see that. Love to see things rocking and rolling on all cylinders. And last week, kind of a sneaky earnings came out with Micron Technology. They came out, everyone popped on board, huge beat and upgrade, and now they're getting upgraded again today. This is a company that I want to look at and watch. Now, they are a memory company, and you think, oh, wow, memory, that's not really AI chips. But in order to make these servers, in order to build this cloud infrastructure, these data centers, these super massive computing power centers, which are taking up all the power in the universe, you need memory. You need to have these components in all these new data centers, and so they're a big part of this. Even though they don't have the super fast AI chip, they do have. They are one of the largest memory producers in the game. So yes, I really do like the recent upgrades. I really do like the recent performance and their guidance. But if you look at them versus NVIDIA, it doesn't look so great, right? So NVIDIA just absolutely owns this market. Everyone knows about NVIDIA. But I kind of just feel like maybe it's played out in NVIDIA. People, they have the huge PE. Everyone knows NVIDIA now. Do they? Is Micron also as well known? Well, here's what it looks like just over the last quarter, Brian, between these companies. So this is NVIDIA is blue, SMH is the goldish orange, whatever you want to call it, and then you have the Micron. It's kind of what I like about it, because it does really look to me, Brian, like we have some double bottoms going on here with NVIDIA and the semiconductors and with Micron. But what I love is that they actually were able to make just a little bit of a higher high here. So yeah, I'd love to see them catch back up. There's a lot of room for them to do so. And, by the way, was their all-time high is way up here above 150. So, I think there's potential upside here for Micron.
Yeah, this is a stock that we own for clients, that Equity Armor owns for clients. For me, let me give you my personal standpoint on this. There is this web of artificial intelligence companies that are all involved, and it starts the software, right? The Microsoft, ChatGPT or Amazon's cloud or et cetera, Google. All those have the software, right? Then there is the chips that are driving the performance of these AI systems. And I think NVIDIA was one of those names that people just kind of overlooked and didn't realize how much of a player they were going to be in this whole space. And I think they had a massive run up to sort of catch up to everybody that was sort of chugging along in the industry space. And so now you talk about over the last year, where are things trending? I think it has to be looked at as a whole web, from the software to the chip makers to the data storage to even cooling and electricity that goes into it downstream. And who are all those players, and what does that web consist of? Because those will probably all now move together to the upside, with a few players probably dropping off and a few new players coming in. And I think when we talk about the SMH, it's going to need this whole web sort of to look very good And for that to move higher, I think for this economy to continue to grow. And so, just to turn the clock back here on what you spoke about the SMH chart, I should say, I would like it to see it start to make higher highs after this bottoming process in order to say, hey, the rest of the market is going to go higher with it. And then to this point, yeah, Micron, I do believe, is starting to play a little bit of catch up here. It's been a nice winner for us, but I'm not really willing to just sort of take everything off the table. I'm not going to make it a huge holding of mine, but I'm going to have it somewhere in my portfolio.
And yes, exactly right. And maybe for me, for the SMH to make these higher highs, Brian, it doesn't have to come from NVIDIA. NVIDIA's at a really high valuation. NVIDIA's had a tremendous run. I'm not saying it can't go higher, but there are other potential companies. We talked about Intel a few weeks ago. They've had a tremendous run after that trade. And now here's my trade here in Micron Technologies. This was this morning looking at it. It was at 104. I just want to look out for another quarter, looking into the January expiration. And the similar trade that I've done recently, and this is another way I just can play these names, limit my exposure, kind of enhance my return too by capping myself out here. So essentially I'm buying the 100-130 call spread in the money call. I own it, and I'm selling a 90 put. Now, to put this all on, I actually can collect money. Not only can I collect money, Brian, but I also get to keep most of that capital in cash. So I'm going to be paid twice here. I'm going to get paid some interest on my cash, and I'm going to get paid to sell these two options against my long call. So I'm collecting $1 for one quarter. It's basically, $4 annualized, basically $90. That's like 4.5% annualized. I'm probably going to earn close to that on the cash I have too. So I'm getting some extra yield just to be sitting here waiting. And by the way, it could drop 10% and I don't lose anything. I still get my yield and my premium here. It's got to drop under 90, and then I'm exposed to the name. Well, I want to own Micron anyways. I'd be very happy to own it under 90. Again, my break even is going to be my premium plus the interest I earned on my cash. So somewhere around $88. Be very happy to own Micron. And by the way, if it rallies, I'm in it. I'm in it all the way up to 130, Brian.
Yeah, I mean, this from a risk reward standpoint I love this, right? So it's you're gonna make 100% of the first $26 up move. If the stock were to go down $26, right, you're only gonna lose 12. So you're risking less than 50% of the value of a similar down move, and you're getting 100% of the up move. So from a risk reward standpoint, this is fantastic. Then you look at the charts here, and I say to myself, hey, stock broke above 100. The momentum is to the upside. I want to play it in that fashion. And also on top of that, I've almost created like a structured note kind of play on this where I'm collecting like a 9% annualized yield. I know it's not 9% from now until January, but annualized yield on top of that. So I get some income coming into the portfolio. I get to play on the AI and all that. And 130 I think makes sense as a target to sort of probably take a breather before it thinks about moving to all-time highs again. What is that? Probably about a 2/3 retracement from high to low, right?
Yeah, I know, but it coincides also with like this previous spot right here. I'm really excited about this for me. So it's how I'm playing. I'm not recommending anyone else do it like this. If you have your own thoughts about it, let me know. Be happy to talk about it. Here's we got a comment, got a question. Let's see. I'll let you feel this one. With the surge of Micron and semiconductors, how do you hedge yourself against potential geopolitical tensions that could affect global supply chains?
Yeah, I mean, we really didn't talk about. We had on the top of the list just Israel being in the news, and obviously them expanding their war front, and basically trying to eliminate some of the risk to their country and the problems that they have. I thought it was interesting that Netanyahu basically came out and said, sorry to get off a little bit off the topic, but basically say, hey, we want to be one with with the Persian people, and we want to grow economies the same way everybody else does in the world, under a peaceful environment and work with each other. There really is no need for constant, war and animosity. So I thought that was like an outreaching hand that he had there. And, in terms of other geopolitical tension, obviously there's China and Taiwan and the risks there, and certainly, how all that plays out. I mean, that's always going to be underpinning, and that's why there is levels of volatility in the marketplace. But this is why, I like an option trade like this, because to some degree, it removes not only stock market risk, just, on a macro environment, but it removes some of that geopolitical risk that can pop up, and all of a sudden we have something break out that we didn't expect. The market gets shooken up about it. But ultimately, the world has figured out how to resume itself, mitigate some of the tensions that go on in the world, and then, push forward. So this kind of, helps me sort of limit volatility in my portfolio.
Yes. Couldn't have said it better. Let me think. So yeah, if there's a short-term event, it would be a buying opportunity for me for a lot of these chips. That's another reason why I like this trade. If we do go lower, I do want to own these names 100% for sure. I also like the CHIPS Act. I gotta say, I like the fact that we're going to be trying to make more of these chips at home. I think that'll be really good long term for us. Hopefully Intel can get it together and start making some of the faster chips. But we also have more plans coming up with some of the other companies. We have Taiwan Semi is going to be making some chips in America, some others too. So that's also beneficial. But back to Israel, that was on my radar at the top of the show, Brian. It just seems like things are spiraling, and we're at a spot where things really could go sideways. Talking about Iran, some sort of blockage of Hormuz that could cause an oil shock. That would be a volatility event if that happened. That could cause things to kind of shut down. Oil obviously be very expensive around the world if that happened. Thankfully, there's a lot of oil in America, but it doesn't really matter. The price is going to be a lot higher if that were to happen. I'm kind of leaning towards, it's election related. I think Iran wants to wait until after the election because they have a preferred candidate, and I think Israel wants to get everything done before the election just because they have an outcome that they would prefer too.
Yeah, the expansion on two fronts in Israel, and potentially, now rolling tanks up into Lebanon, and trying to clear out and protect their people in the north. I think that has the markets a little bit concerned here. I think that's why volatility is a little bit higher, that this war is going to continue to expand. I personally think it's something where Israel was just spotting weaknesses to remove some of the terrorist network that was causing problems, with their country, and, providing more safety for their citizens. And I don't know that expansive wars is concerning for me. On a geopolitical front, I think the level of volatility rising, the VIX futures being up, that curve being out of whack that we talked about earlier in the show, I think that all relates to, the week ahead. That November election is just, between an election, Federal Reserve rate decision, another unemployment data point. There's a lot to digest from a macro standpoint that has me more worried whether these markets can go higher or lower, because I think ultimately, maybe next show we spend talking about this, but I think a 60% move one way or the other in the markets over the next year is a possibility, and I'll leave people with that. And hopefully everybody comes back and tunes in next week. Is our show every Monday, 1 p.m. Eastern, the trading zone.
Well, wait.
Oh, you got one more thought?
Okay. Yeah, I think there's a lot to unpack here, though. So we've been talking about 07 and 98. 07 had the housing crisis, which caused the 60% drop. 98 had the dot-com boom, which caused a 60% rally that turned into a huge margin event, huge bubble that blew up, right? So those are two possible scenarios. It happens a lot in history we had a bubble crash, a housing bubble, a dot-com bubble, two crashes. Another scenario what happens a lot in history we have not talked about for a while is an oil shock, which causes markets to crash too. So we're kind of hitting all three right now, Brian. I think that is a real concern right now for me, given the level of tensions. I think people, are not really aware of how serious this. To me, this is very dire. The risks of an oil shock are very real now. Much since like 92 or 91 we had the first Gulf War.
Well, here, look, I'll tell you this, let's do this. Next week we should get into talking about, let's tease it, leave people teased a little bit. We'll get into this is really like a whole show discussion. We're going to talk about oil shock next week. We're going to talk about the level of volatility in this market, sort of give a playbook of how some of these, because we had some really good questions about geopolitical tension, how that would play out. And I think we have to come up with answers for people. So let's leave people with that, and tune in next week, right? And we'll get into this discussion and do a little playbook on, what if scenarios, if A happens, what do we expect, out of B, so that people can be well prepared to invest in the market. That's what we like to do. That's what I like analyzing and give people advice on. So please tune in next week, along with the launch. Again, our new subscription product will be coming out next week. We're very anxious to have people join us along on the trades, such as a Micron, for example, such as our artificial intelligence web network that we put together in an option trading fashion. And we do some volatility arbitrage trading as well on the SPY ETF. So tune in every Monday to the Trading Zone, sponsored by the MIAX. I'm Brian Stutland, Equity Armor Investments, with my colleague Joe Teague at Equity Armor Investments as well. Look forward to seeing you every Monday, 1 p.m. Eastern.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.